Apollo, not the only company reporting a decline in earnings. Invicta also taking a knock during the interim period. The group reported a 14% decline in headline earnings per share due to a stronger rand, which weighed on its bottom line. And joining me to unpack the numbers is company CEO Stephen Joffe. Thank you so much for your time, Stephen. Now let's actually start off with the revenue. At what level of comfortability are you with that top line growth? And looking at it quite tepid.
Obviously we'd want more, but we have to understand we were in an election year and people were quite hesitant to spend money in the early part of the 6-month period. So we had a very difficult April, difficult May until the 20th of June and the Government of National Unity, and then things started to improve quite rapidly.
All right. And of course, looking at even that slight revenue growth, it didn't filter down to the bottom line where we saw declines there in profit and headline earnings per share. What were the main pressure points that led to that even bigger pressure on the bottom line?
So strategically, we made a decision a few years ago that we wanted to build a business that was at least 50% offshore. And by that I mean 50% of our profit to be derived from offshore businesses, and we've been very successful in that regard. So post the election in South Africa and the Government of National Unity, the rand strengthened amazingly, about 9.2%. At the beginning of the period, $1 would buy you 19 rand 86 cents. At the end of the period, 17 rand 22. Now, because we've got all our offshore businesses, we have to translate them back to rands. And that rand strength affected the translation. So if you look at our numbers, you'll see at the operating profit line, we were actually 11% up, 7% up sustainably. And at the bottom line, we were down primarily due to an interest rate loss that happened in the 6 months.
All right. Well, thank you very much for clearing that up for us, Stephen. Let's take a look at your margins. How are those looking, and your navigation and stabilization of those margins there?
So margins have been pretty much the same. In our capital equipment business, what we found was there was surplus stock post the election because people were holding back and there just was extra stock in the market, and the margins are a bit under pressure. But as a group, we managed to maintain our GP percentages.
All right. I mean, just in terms of your asset management efforts there, you have embarked on an acquisition and disposals. What criteria is forming your base decisions here for what you acquire and let go of?
Well, it's cash flow and RONA. Those will be the most important items that we look at. But in the case of our disposal, it was more a realignment. We sold the business KMP to our undercarriage business K&N, because we feel that we sell the undercarriage and the engine parts to the same customer. So we feel it's better aligned to be held in the K&N group.
And I mean, just also, how much runway, if there is runway, for any more acquisitions that you make at this point, and particularly offshore, as you are obviously going on this effort of deriving half of your profits offshore?
Well, one of the things we reported today in the K&N business, we've got $65 million of net cash, and we've just sold the warehouse in Singapore for $63 million, and we'll net about $57 million. We'll pay a dividend of $14 million, but we'll leave an additional $17 million. So we've got a lot of cash lying in K&N to make acquisitions. So our other offshore businesses are also sitting on cash. When we remit the dividend back to South Africa or from K&N, plus all our other cash generation that should take place in the second six, we should be down to about 500 million rand of net debt, leaving us with plenty of leeway to make acquisitions on our facilities in South Africa.
All right. Well, I mean, Stephen, you operate in industries that require meaningful turnaround in the economic landscape for them to grow sustainably. And I mean, you spoke about the more positive sentiment coming from the GNU. Does that encourage you in your outlook in terms of your South African businesses?
It does. I think the biggest thing, and I think people forget quickly, is that the lights are on. Like, it's very difficult to run industrial businesses in the dark. So we're very grateful for this. This full 6 months, we never had load shedding. So that's been a terrific improvement. And then obviously we need like our mines to do well. So we're looking for the railways and the ports to be improved. But the fact that the Eskom was turned around so efficiently just gives us hope. And if those turnarounds happen, we think we can play really well in that space.
And of course, we are talking about external factors, but internally, what will your focus be on in the short to medium term?
I think our activity, I always judge a business by the activity of management. I'm pretty happy with the activities of management. I think everyone's trying as hard as they can. They're chasing every deal. They're looking for everything they can. They're cost conscious, and that's how they managed to eke out that operating profit growth this year, even with the 2% turnover growth. So I think we've got a good team working hard, looking for sales. I'm satisfied with the activity. It would just be nice to get a bit of tailwind from South Africa growing.
Yes. All right. I hear you on that. Well, thank you so much for your time, Stephen. Of course, looking forward to the results that you produce in the second half of the year. Well, that was the CEO of Invicta, Stephen Joffe.